Ladies and gentlemen, welcome. Today we face a moment of truth, a jobs report that startled markets, challenged assumptions, and demanded that we recalibrate. When a seemingly routine statistic turns into a tectonic tremor, we have two choices: recoil or lean in. I say let's lean in. When we look at the world today, we see a financial system that feels familiar, comfortable, and predictable. But comfort can be deceptive. For too long, the global economy has leaned on a single pillar, one dominant currency to price, trade, and store value. And while that structure has served as the backbone of growth for decades, it's also created a profound vulnerability, a silent concentration risk that few truly understand until it begins to fracture. Relying on one currency is like building a global house on a single foundation. As long as the weather stays calm, everything appears stable. But when winds shift, when debt piles up, when inflation takes hold, or when trust erodes, that same foundation can crack. And when it does, the shockwaves ripple across borders, through markets, and into every portfolio, business, and household on the planet. We have entered a new era where diversification isn't just a strategy, it's survival. The rise of new technologies, the evolution of decentralized finance, the reconfiguration of global trade routes. All of these forces are quietly reducing the world's dependence on any one system, any one standard, any one currency. It's happening slowly at first, and then all at once. For decades, investors and policymakers operated under the assumption that one currency would always dominate. It was the language of global trade, the benchmark for energy, commodities, and capital flows. But that dominance came with a cost: fragility. When one currency dictates the pace of global liquidity, every tightening cycle, every political standoff, every fiscal misstep sends tremors across continents. Emerging markets, often innocent bystanders, pay the heaviest price. Their currencies tumble, their debt burdens rise, and their growth stalls. All because the world is tethered to a single monetary anchor. But technology once again is rewriting the script. Digital assets, blockchain infrastructure, and alternative payment networks are quietly building an ecosystem that doesn't depend on a single authority. These innovations are not about replacing one currency with another. They're about creating optionality, giving individuals, companies, and countries more control, more resilience, and more freedom. That's what true diversification means in the financial sense. History teaches us that concentration always leads to disruption. Empires, markets, and currencies rise on credibility and fall on complacency. When confidence in a monetary system fades, capital doesn't wait. It migrates toward new forms of trust, new technologies, and new frameworks that can sustain growth without the weight of legacy inefficiencies. We are watching that process unfold right now. In moments like these, the temptation is to cling to the familiar, to believe that the old system will adapt fast enough to outlast every challenge. But innovation doesn't wait for permission. The same way technological disruption upended industries, financial disruption is reshaping the global order. What once seemed impossible, the diversification of global reserve assets, the digitization of money itself, is no longer a theoretical debate, it's a practical evolution. For investors, the message is simple: diversification is not only about sectors or geographies. It's about monetary exposure. Think about what happens if a single currency weakens dramatically, or if global confidence in its long-term value erodes. The ripple effects would be enormous. Inflationary pressures, capital flight, rising asset volatility, all symptoms of the same underlying risk: concentration. And yet, within that uncertainty lies opportunity. The companies and technologies positioned to enable more inclusive, borderless financial systems stand to benefit immensely. Payments, blockchain infrastructure, tokenized assets, these are not passing trends, they are the infrastructure of the next monetary era. They represent the market's collective desire to move beyond dependence and toward resilience. This shift will not be linear. There will be periods of volatility, regulatory friction, and pushback from entrenched systems. But ultimately, innovation moves in one direction: forward. Just as the internet democratized information, decentralized finance is democratizing trust. The future will not belong to one currency or one institution. It will belong to systems that empower choice, transparency, and global access. The question is not whether the world will diversify away from one currency. It's how prepared we are when it happens. Are we positioned for resilience or exposed to concentration? Are we looking at short-term fluctuations, or are we studying long-term cycles that redefine value itself? Change, as always, begins quietly, but when it arrives, it rewrites everything we thought was stable. The smartest investors, the most forward-looking leaders, will not wait for consensus to confirm it. They will position ahead of it, thoughtfully, courageously, and with conviction. Because in a world that's shifting beneath our feet, relying on one currency isn't just risky. It's the very definition of standing still. There's a quiet power in ownership, real ownership, not the fleeting kind that lives in numbers on a screen or temporary market sentiment, but ownership that's anchored in reality. In a world that's becoming increasingly digital, intangible, and leveraged, it's easy to forget that true wealth has always been rooted in things that endure, assets that create value, generate productivity, and withstand the cycles of fear and euphoria that define every era of finance. Owning real things isn't just about physical assets, it's about holding claims on innovation, progress, and productivity. It's about participating in the systems that make the world move forward, rather than speculating on abstractions that vanish when confidence fades. We're living through one of the most transformative periods in economic history, where the line between the real and the virtual blurs daily. Yet amid that transition, tangible ownership of resources, infrastructure, technologies, and intellectual property remains the foundation of resilience. For too long, investors have been lulled into believing that financial engineering can replace fundamentals. Derivatives, leverage, and artificial liquidity have created layers of complexity that feel sophisticated but often detach capital from real economic activity. The illusion of wealth expands when interest rates are low and liquidity is abundant, but when those tides recede, only the assets grounded in real productivity remain. That's the moment the world rediscovers the value of owning what's real. Look at history. Every major turning point in markets follows the same rhythm. Periods of speculation are followed by rediscovery of tangible value. In the 1970s, when inflation eroded confidence in paper assets, investors turned to commodities and real estate. In the 2000s, the digital revolution shifted focus to real innovation, companies building platforms that change the way the world communicates, shops, and learns. Every cycle has its moment of clarity when the market remembers paper wealth is temporary, but ownership in transformative assets endures. Today, we are once again approaching that point of rediscovery. The global system has relied heavily on debt expansion and liquidity injections, creating a false sense of security. But under the surface, something profound is happening. Supply chains are being rebuilt, resources are being repriced, and technologies are creating new forms of tangible value. Energy infrastructure, critical materials, data centers, and intellectual property all represent the new frontier of real. Owning these assets isn't just a financial decision, it's a strategic one. Owning real things is also psychological. It demands patience and conviction. It's not about chasing momentum. It's about understanding the direction of innovation and aligning with it before the rest of the world sees it. When you own something real, whether that's productive land, transformative technology, or even a piece of a company that's solving a genuine problem, you own a share of the future. You participate in the compounding power of human creativity and progress. Too often, fear drives investors into cash or speculation. They move between extremes, hoarding liquidity when confidence fades, or over-leveraging when euphoria returns. But both approaches miss the essence of wealth creation. The goal isn't to time the waves, it's to own the vessel that can weather any sea. Real ownership gives you that vessel. It's what allows you to endure volatility, because you're anchored in something that creates real value, not something that only trades on sentiment. Even as the world shifts toward digital economies, tangible value still matters. Data may be the new oil, but the servers that store it, the energy that powers it, and the algorithms that extract meaning from it are all real. Artificial intelligence, robotics, biotechnology, these aren't abstractions, they are productive systems built on intellectual capital, infrastructure, and creativity. Owning them means owning the future itself. In every economic cycle, the temptation to speculate is strong. It feels faster, easier, more exciting. But real wealth doesn't come from speed, it comes from endurance. The most successful investors of every era were those who understood that the greatest returns come from holding assets that compound over time, not from chasing every short-term movement. Real ownership rewards patience. It's the bridge between vision and reality. So as we stand on the edge of massive technological and economic transformation, the message is simple: own what's real. Own the innovations that redefine productivity, the resources that power the world, the ideas that turn into enduring enterprises. Because when liquidity tightens, when volatility spikes, when speculation fades, it's the owners of real things who remain standing. And that's the paradox of progress. The faster the world moves, the more valuable solidity becomes. When everything feels uncertain, the anchor of ownership becomes priceless. In the end, wealth is not a number. It's a claim on what's real, what's productive, and what endures when the noise fades away. In every market cycle, there's a moment when conviction gets tested, when volatility rises, correlations break, and comfort gives way to uncertainty. It's in those moments that diversification reveals its true purpose, not as a buzzword or a mathematical exercise, but as protection. Protection against the limits of our foresight, against the illusion that we can predict the unpredictable. Because no matter how much data we analyze or how confident we feel in a single theme, the future always finds new ways to surprise us. Diversification isn't about diluting conviction, it's about strengthening it. It's the quiet discipline that keeps investors standing when others fall. It recognizes that every innovation, every trend, and every cycle carries both promise and risk. Concentration may feel powerful in moments of euphoria, but when sentiment turns, it exposes fragility. The greatest portfolios, the ones that truly endure, are built with an understanding that protection doesn't come from prediction. It comes from preparation. The beauty of diversification lies in its humility. It accepts that even the most informed investor cannot know everything. It respects the complexity of global systems, the interplay between policy, innovation, demographics, and technology. It allows room for the unexpected, for the unseen disruptions that can alter entire industries overnight. By spreading exposure across ideas, assets, and time horizons, we give innovation the space to breathe and resilience the chance to compound. Throughout history, the biggest losses in markets weren't caused by lack of opportunity, they were caused by overconfidence in a single narrative. Investors believed one asset, one industry, one currency, or one strategy could protect them indefinitely. But innovation, policy, and human behavior are dynamic. They evolve often faster than models can adapt. That's why diversification matters, not because it guarantees returns, but because it ensures survival when the narrative shifts. Today's world is more interconnected and more volatile than ever. Technology spreads ideas faster than policy can respond. Supply chains, once predictable, now move with geopolitical tides. Inflation, interest rates, and consumer behavior can turn with astonishing speed. In such an environment, concentration becomes risk, and diversification becomes strength. The portfolios that thrive in the next decade will not be those that guess perfectly, but those that adapt gracefully. Diversification doesn't mean owning everything, it means owning wisely. It's about aligning exposure with different sources of growth, not different versions of the same story. True diversification blends the exponential potential of innovation with the stability of tangible assets. It pairs conviction with optionality, high growth disruption with steady compounding. It recognizes that resilience and performance are not opposites, they are partners. Think of diversification as the immune system of a portfolio. It doesn't prevent volatility, it manages it. When one part weakens, another strengthens. When one theme faces headwinds, another catches the tailwind of progress. Over time, this dynamic balance creates endurance. It turns temporary shocks into opportunities for reinvestment, allowing investors to stay the course when others retreat. In the last decade, Many have mistaken diversification for indecision. The world rewarded concentration, especially in sectors that seemed unstoppable. But markets have a way of reminding us that nothing moves in a straight line forever. As innovation cycles mature, as policy frameworks evolve, and as capital costs shift, the leadership of markets rotates. Those who diversified, not just across sectors but across ideas, find themselves not only protected but positioned to capture the next wave. Even innovation itself needs diversification. Every breakthrough carries execution risk, regulatory risk, and timing risk. Some technologies accelerate faster than expected, while others take years to scale. By holding exposure across multiple transformative platforms, energy, automation, genomics, artificial intelligence, we don't just hedge risk, we maximize participation in progress. We allow innovation to surprise us in the best possible way. Diversification is also emotional protection. It allows investors to think long-term, to avoid the panic that comes from watching a single bet swing violently with the news cycle. It restores perspective. When one part of the portfolio struggles, another reminds you why you invest, to participate in human creativity, not to react to noise. This balance of conviction and caution is what keeps investors from being swept away by the crowd. In moments of turbulence, diversification gives confidence. It allows us to stay invested through uncertainty, knowing that not every piece moves in the same direction at the same time. It's not about avoiding risk. It's about absorbing it intelligently. Because real growth never comes without volatility, but diversification transforms that volatility into endurance. So, as we navigate a future shaped by rapid innovation, policy shifts, and global interconnection, the message is clear: protection doesn't come from hiding. It comes from balance. It comes from recognizing that strength lies not in betting on one outcome, but in being prepared for many. Diversification isn't a defensive stance, it's an offensive strategy for the long term. In the end, every cycle rewards those who can adapt without losing vision. Diversification is how we do that. It's how we stay invested in possibility while protecting against fragility. It's how we turn uncertainty into resilience, and resilience into enduring growth. The world often moves in waves that few recognize until they have already broken. Markets, technologies, and societies rise and fall in long-term cycles, patterns shaped by innovation, capital, psychology, and policy. Yet most people focus only on what's directly ahead. They trade today's fear or chase yesterday's success. But those who understand cycles see beyond the noise. They see that every downturn plants the seeds of the next expansion. Every disruption carries within it the blueprint of the next opportunity. Thinking in long-term cycles isn't about predicting the future perfectly. It's about positioning yourself where progress inevitably flows. When you zoom out, patterns emerge that short-term volatility hides. Economies evolve in phases, periods of acceleration driven by discovery followed by consolidation, and then renewal. Each phase feels different, but together they form a rhythm. Innovation acts as the metronome of history. It begins quietly, often dismissed by the mainstream, then accelerates exponentially as adoption spreads, and finally resets the system before the next wave begins. The investors, entrepreneurs, and nations that understand this rhythm don't fear downturns, they use them. They recognize that cycles cleanse excess and prepare the foundation for growth that's more sustainable and profound. Short-term thinking is seductive. It rewards immediacy and punishes patience. It makes us feel like we're in control. But in reality, reacting to each data point or market movement is like trying to navigate a storm by watching the waves instead of the tide. True progress happens slowly, then suddenly. And if you can step back far enough to see those slow movements, the demographic shifts, technological curves, productivity inflections, you begin to realize that timing the noise matters less than aligning with the trend. Long-term cycles are often misunderstood because they don't conform to our attention spans. The human brain craves linearity, but the world moves exponentially. Innovation compounds, policies lag. That mismatch creates opportunity for those willing to look through the short-term disarray. When others are caught in quarterly expectations, long-term thinkers invest in the next decade. They understand that disruptive innovation doesn't follow the calendar. it follows adoption curves. And those curves, once they start rising, change everything. Take any transformative era in history: industrialization, electrification, computing, the internet. Each began with skepticism, followed by mania, then correction, and finally maturity. The pattern repeats because human behavior repeats. Fear and greed shape the middle of the cycle, but vision shapes the beginning, and conviction shapes the end. That's why thinking long-term isn't just an investment philosophy, it's a mindset. It requires trusting that the same forces that built progress in the past will continue to do so, even when the headlines say otherwise. Cycles are not just financial, they are emotional. When optimism peaks, discipline fades. When pessimism dominates, opportunity hides in plain sight. The key is to act counter to emotion but aligned with logic. When the world becomes fearful, valuations compress, and innovation is doubted, that's often the point of maximum potential. Because every great transformation is born from disbelief. Thinking long-term allows you to see through that disbelief, to focus not on where sentiment is, but where innovation is going. Long-term cycles also remind us that progress is cumulative. Each wave builds on the one before it. The technologies of today exist because of the breakthroughs of yesterday. Artificial intelligence builds on computing, which built on semiconductors, which built on electricity. Progress compounds just like capital. Understanding cycles means understanding that the next wave of value creation doesn't erase the last, it amplifies it. In the financial world, this perspective is rare but essential. Most strategies are built for the next quarter, not the next decade, but the real asymmetry of returns happens when vision meets patience. It's in holding through volatility, not avoiding it. The greatest investors in history didn't earn their success by predicting every move. They earned it by aligning with the unstoppable force of technological and societal advancement and refusing to be shaken off course by short-term noise. Thinking long-term also demands intellectual independence. Consensus thinking lives in short cycles. It thrives on immediate feedback and constant validation. But the long view often looks wrong before it looks brilliant. It requires conviction when the crowd doubts, because most of the world prices in fear faster than it prices in innovation. Yet when that innovation begins to manifest, the shift feels instant, even though it was years in the making. So when volatility spikes, when markets seem irrational, when cycles appear to be ending, remember that endings are often beginnings in disguise. A correction in one phase creates the energy for expansion in the next. The key is to stay focused on the forces that endure: technology, human ingenuity, productivity, and adaptability. These are the constants across every cycle. The world rewards those who can hold a vision through the noise. Thinking in long-term cycles doesn't mean ignoring the present. It means interpreting it as part of a larger story. It's seeing beyond panic, beyond hype, and recognizing the invisible compounding of progress happening underneath. Because history doesn't move in straight lines, it moves in waves. And those who learn to ride those waves instead of fighting them don't just survive change, they define it.